Expenses are going up because we're doing the right things to the property. Rents are usually going down a bit because we're getting rid of some people that maybe shouldn't be there. And then all of a sudden you have that turning point where costs are less and less and the rents start going up. When that starts to happen, it just starts to snowball.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
Hello and welcome to episode 52. As we kick off 2017, I want to thank all of you listeners out there who have made this show what it is today. And I've really appreciated those of you who have taken the time to go to iTunes and give us a review and a rating. That's very helpful, and I really appreciate that. And I'd also like to thank all of you who have taken the time to reach out to me, either through email or even some phone calls that we've had. It's always a pleasure to hear from you and know what you're thinking and that you appreciate the show. One of the things that has come up quite often in conversation with you, the listener, is why don't I talk more about myself and the deals that I've done? So I thought I'd do that today. Probably the best way to go about that is to bring in and introduce you to my property manager as well as my business partner on several deals, Marty Green. Marty owns Green Property Management here in Grand Rapids, and he covers the West Michigan area as well as Lansing. Marty, thanks so much for being on the show today.
You're welcome, Brian.
Now, we're here to talk about us today and the deals that we've done together. Your story will be told in a later episode. You have a fascinating background and a lot of experience, but why don't you just tell us a little bit about yourself in a nutshell?
All right. I grew up around the industry. My father had several income properties in the Lansing area. As I got older, I decided I would never do this because I hated it at the time because my dad would drive us pretty hard. But 30 years ago, decided to, with my wife, to get involved and try out a little bit of a test on some real estate. I think we got in a little bit of a financial crunch, and I thought, oh boy, maybe we'll try to fix up a house and sell it and see if we could make any money. And very quickly, I found that that felt pretty good. There was some money to be made in flipping some houses and then owning some income properties. So we really had a great stretch for a long time. I would work as in sales and in marketing for some larger companies in town. But on the side, I did income properties and flipped houses. 04, 05, 06, we did several hundred houses at that time, and just, we'd buy in bulk from banks and turn them. We also got hit hard in 07, 08 like everyone else, and that's for another story. We worked through it, and we continued to invest, and one of the strengths that we ended up coming out with was our property management company and a unique way to manage. And again, that's for another time as well. We found creative ways to get back on our feet and invest in larger complexes. We've got 30 plus years of experience. I try to find unique ways to put deals together. And when you and I started working together, it's been a perfect partnership in the growth that we both wanted.
I came to know about Green Property Management because you were managing larger apartment communities.
Correct.
And there were several in town that I would drive by, and I could see the transformation that was happening. I mean, it was around the time you took over management. And I think you inherited, as a management company, you inherited some pretty tough apartment communities.
Absolutely.
And turned them around.
Yeah, we really pride ourselves in turning around complexes that have had struggles. To me, that's where there's some opportunity right there in front of your nose. So.
Give me an example of some of those struggles that you have to turn around.
When I first got in the industry, we didn't have a lot of money to invest, so you sort of would take what you could get and deal with what you could deal with. The problem is, what I didn't realize is that the building looked tired, and we'd go in and we would clean it up, and the people ended up being more of a problem than the property. You'd go and collect rent, and there was times where I'd walk in and there'd be guns on the table and things going on that shouldn't necessarily be going on.
This is a G-rated podcast.
Oh, sorry. But anyway, but it really it made being in the business colorful. for sure. But what I decided quickly, probably within a few years of being in the business, was that if you can control a neighborhood, you could have more success with turning a tired unit. Instead of buying a unit that I could just only afford, I tried to figure out ways to buy a block. One of the areas that I had bought was in an up-and-coming area near a hospital, and I knew that more was going to happen in the future. I approached the owner of these properties. It consisted of 4 big buildings in a 2-block radius, and negotiated with them to buy it on a land contract. And so we bought it, cleaned it all up, changed the clientele in there because there were drug dealers, prostitutes. We turned it in about a year and a half, 2 years, and sold it 3 years later, made a large profit, and then started to reinvest in other real estate deals.
Yeah, so by taking control of the neighborhood and the block, you were able to turn it around pretty dramatically there.
Yes.
And I'd imagine with apartments, large apartment communities, it's a similar thing. I mean, you're basically buying a neighborhood
right
when you buy an apartment complex.
And that is the beautiful thing about apartment complexes is that you are buying the neighborhood. And you have to make a decision at that time. Do you want to empty out the building, or do you want to dissect it and just have that careful balance and a slower change, but still effective? We have chosen to do the latter. We think that there's just phases that come along with buying a complex. You have to be a little bit patient. We've got it down pretty good now.
And there's a strategy involved in that. I mean, definitely when you go in, you have to have the money and the funds
Yes.
to do what's necessary.
Yes.
And I think, and this is kind of where I want to talk about us, because part of that strategy is being able to assess the property early on before you purchase it. Because I had 70 units in Grand Rapids in Wyoming, and they were smaller multifamily type properties. The largest I had was a 37-unit apartment complex. And they were all doing well, but there's a difference. There's a difference in mentality and strategy between managing the smaller multis and the larger apartment communities. I reached sort of a plateau in my investing. Once I reached this plateau, I realized, okay, I want to invest in larger apartment communities. The smaller multifamilies are good, and I'm happy with them. But to really get that exponential growth, I've got to go bigger. That was the point I was at probably around 2011, 2012. Mm-hmm. And that's when you and I kind of met. Because of what I'd seen you do at these other larger communities, that you had the team that really understood how to look at these properties and assess them, so that you knew going in what was going to be necessary to make it a success as far as the management and the operations, and the improvements that needed to go into it, and then just make it a success financially as well. So I realized, and this is part of the theme of our conversation, which is partnering, strategic partnering for exponential growth. I realized that in order to achieve growth in my investment portfolio, I needed to partner with someone like you. At first, just bringing you on as a management company. Then later on, you and I became partners in several deals. Because that's so important, because you, not just you, but the people who are on your team at Green Property Management have that knowledge to be able to look at a property and understand it, and you know, the way it operates and the way it's put together and where the plumbing is and things that, frankly, I don't understand. Right. But partnering with you, I'm able to kind of fill those areas with your knowledge. I want to give an example of just something that early on in our conversations you said that I thought, well, wow, that makes a lot of sense. You know, one of the big expenses at these apartment communities is carpet replacement.
Right.
And I remember just in some of my initial conversations with you, you had talked about what you were noticing was that the carpet was really wearing out around the entry door.
Right.
And because of that, it would get worn out and you'd have to replace all the carpet. So you had instituted a policy to put vinyl flooring or tile flooring right there at the entry, so that the carpet would still stay in good shape and last longer, basically. Right. And that cuts costs dramatically, because if you look at your bottom line, carpet replacement in these communities can be a huge expense.
It's one of the largest expenses that seems to be ongoing. But again, we strategically looked at wear paths and just said, will it look aesthetically right if we were to put tile down in certain areas, and it's the return on your investment long term, not short term, it tends to be a better investment. That's one example of ways to save money in larger communities because you're doing it over and over and over again. Lighting is important. Low flow faucets are important. The trick is to bring the tree huggers together with the capitalistic pigs. And I think what we've done really well is we've been able to say, okay, these are the things that make sense, and this is why they make sense, so that you can make more money in the long run. Short term, maybe not. Long run, for sure. And frankly, it's the right thing to do. That was difficult at first, especially when we didn't own the properties, when we were just managing them, to try to convince an owner to spend money, to down the road make money. And if you said it was also environmentally friendly, for some reason, some people had this knee-jerk reaction that, oh boy, they're just doing it for that reason.
Yeah, and one of the key ways to increase your net operating income, which is so important to the financial wherewithal of your investment, increasing your net operating income involves decreasing your expenses.
Correct.
So any type of cost-saving, energy efficiency methods that you can put into an apartment community, whether it be LED lighting or the low-flow faucets that you talked about, that goes to your bottom line. That helps improve your net operating income, and it forces appreciation on the property. Now, your company is called Green Property Management.
Right.
And that's because your last name is Green.
Correct.
But you've also managed to bring in a lot of those green cost-saving elements as well.
Absolutely, and not only that, we feel that's the right thing to do. We've introduced composting, recycling into our communities, and we have just found that the more responsible we are as a management company, and the more responsible we are as investors, the more responsible tenants we get. You have healthy properties, you have healthy tenants which means their credit is good, they pay on time, which lowers the cost of operating.
Yeah, so let's talk about some of the deals that we've done together. Let's kind of start with the Lansing 71 unit, because that was where I was looking to grow my portfolio, and I wanted to get into a large apartment community, and specifically through syndication. This was my first syndication deal. So working with you and your team at Green Property Management, we went out to Lansing. This was around 2013, 2014. There really wasn't much available in Grand Rapids. Right. So we went to Lansing, and we found a 71 unit that was in good shape, seemingly good shape, and we liked the location. Basically, with your help, we were able to acquire that.
Let me ask you this. I mean, when you first looked at that property, some of the investors involved, did they scratch their head thinking, is it going to be possible to get it to a place where we could make money? Or were they believing in you more than the property?
A lot of the investors were friends and family.
Okay.
Anytime you raise money from people, quite often they're investing more in you than the property. I provided, all the information on the property to the investors, so they knew what they were getting into. Well, some of them came and saw the property, but a lot of them just trusted in me and in the fact that I was working with a reputable property management company, because that's just as important. But going back to the property, it was a good B- C+ asset in probably a B- C+ area. What we found pretty quickly after we purchased it, though, was that while the property was in good shape, there were the people problems that you had mentioned, and that really that impacted our profits in the first couple of years.
I think that's where a lot of people that are interested in getting into this industry, that they drop off. Our approach has typically been, if you want to do a deal with me, expenses are going to go up, rents are going to go down. And right when that comes out of my mouth, people are like, I don't want to do business.
Yeah, clarify that, because there's
so it's like, what? And it's like,
behind what you're saying.
And then you have to like pause and say, well, why is that? Well, expenses are going up because we're doing the right things to the property. Rents are usually going down a bit because we're cleaning house. And that's usually just for a minute. And that's usually because we're getting rid of some people that maybe shouldn't be there.
People who were tolerated
rate,
by the previous
right,
management company.
Exactly.
Who in this case was a very professional, well-respected management company.
They were.
But they missed their
it.
Criteria was not as high as ours.
Right. And that was key. So you can say it and then explain it. But when it happens, I know people take a gulp. Just as expected, because I've seen it and done it several times before, expenses went up because we're doing the right things to the property. Rents or cash flow goes down. The rates didn't go down, but income went down a bit because we're cleaning it out. And then all of a sudden you have that turning point where the costs are less and less and the rents start going up. When that starts to happen, it just starts to snowball. At that point, you've got the right people in there. You've got the property. We're not putting Band-Aids on things. We're fixing them right. It shows after a couple of years. But it's always fun to look at the face of people when I say, well, your expenses are going to go way up and your income's going to go way down. Do you want to do business with me?
But that's the reality because your management style is to go in and improve a property.
Right.
It's not to run it into the ground.
Correct.
And that's an important distinction because there are plenty of people, whether it's professional management company or just an owner, who will be perfectly happy to milk their property and pull all their money out and put it in their pocket and run property into the ground. But if you really want a healthy investment, you're going to need to spend the money going in and up front and during the duration of holding that property to keep it in good shape so that when you do sell it, it's in better shape than when you purchased it.
Every investment we get involved in, it can't be a short term for us because of our management style, as you know. We have to really go in and do it right, or it costs our management company a fair amount of money.
Your management style is to be much more of an investment partner with the owner. Your success is dependent on the success of the property.
Yes.
Going back to the 71 unit, so what we thought we were buying in the beginning was kind of a turnkey property. That was sort of our impression. Mm-hmm. And we had looked at the leases and the delinquencies, and we're relatively satisfied that is what we were getting. But then once we took over, we realized probably within the first 6 months, no, this is going to be much more of a turnaround.
Yeah, and some of that was the things that you can't always identify when you're going through the leases or even the people on the property. For instance, there could be 20 tenants that are all really good friends or related, and 2 of them may be really problem tenants. So you evict them, and all their friends want to go with them. So there's things like that can happen, but when you're looking at these deals on the surface, sometimes there's things you can't see.
We also had some marijuana smoking and possibly some drug dealing. We had sort of a slow, steady method of let's get rid of the problem tenants. But what we were finding out was you'd get rid of a problem tenant and another one would pop up to take their place.
Right, and not because we put them in, it was because we just found that there were more problem tenants existing.
They were already there when we took over.
Right.
But the key, so I know what the key thing is that we did. What would you say is the key thing we did to turn it around?
I mean, there's a lot of things that we did it carefully. We would sort of take a building and we would look at a building. We'd say, all right, which one is the worst building? If they're paying their rent, we'll let them stay in that unit as long as they can, as long as we can tolerate it, while we start to clean up these other buildings.
And there were 4 kind of separate,
right.
Even though it was one big complex, there were 4 separate sort of buildings in that complex.
Yeah, so we started we picked the best building first, actually. And we said, okay, this won't be hard to turn around. Let's turn around this building. And that happened. Then we started to just sort of strategically look at the next building, and then even farther than the building, which floor on the building. And we would strategically get rid of those tenants, and then so on and so on. But it really, where it got tricky was, you just evicted my friend, and maybe they were their drug dealer, who knows, and then they both left.
This property was not meeting its projections.
Right.
So the investors were expecting, a 6% return, cash flow, and we were putting a lot more money back into the property than we would have liked. And that was probably going to continue longer than we would have liked to. Sometimes when you're faced with this as an operator, one of the options is to do a capital call on your investors, where you go back to your investors and you say, we need you to put up more money so that we can solve some of these problems. Here's where we're going to spend that money. I don't like to do that.
Right.
What I prefer to do is go to a particular investor and say, we would like to borrow a certain amount of money that will pay you interest on. It could be anywhere from 6 to 8% interest, and do that instead rather than go back to all the investors. So rather than do a capital call, we got a private loan from one of the investors for probably about $25,000. And we had identified 3 things to do with that $25,000. Some of it involved landscaping.
Right.
Some of it involved lighting, exterior lighting. Right. But the biggest thing that just made such a huge difference was installing video surveillance cameras.
Right. That's really was the turning point, because, again, one of the things that we came up against was, all right, we've got rid of some of these people that were hard, but the people applying were just like the people going out at first. And we're like, well, wait a minute. On our other properties, we really light it up like a Christmas tree, and we put video surveillance cameras around, and then we would market that way. And all of a sudden, you start getting a different audience. They feel safe. They feel like they're in an environment that cares about their safety. And that was a turning point. And I remember that conversation when we decided to say, listen, we need to really go all the way on this and to make the change. And when that happened, it was definitely a turning point.
Yeah, it was interesting because we started getting Michigan State University students.
Yes.
And we were quite a ways away from Michigan State University.
Right.
We were getting Cooley Law students. We were getting young professionals.
Yes.
Including single female professionals. And I think that, I know you've said that by fair housing rules, you can't tell people it's a safe community.
Right.
But I think we really sent that signal because they'd walk into the management office or the leasing office and see the video surveillance monitor.
Right.
So that sent
we didn't have to say
signal.
it.
We didn't have to say it.
We didn't have to say it.
It was there for them to see.
Right.
And that really helped us kind of turn the property around and start getting in the tenants that made a difference.
No, that was huge. In some of our other communities, we do that. In some of our offices, people walk in, they see the monitors, and they're like, especially if they're students and parents are coming along with them to look at properties, they walk in and they'll say, boy, I feel safe to have my kid live here. And we don't have to say it. Yeah. They just say it themselves.
In fact, all 3 of the properties that we have done together have video surveillance.
Yes.
That's one of the important must-haves now for us. The good news with this 71 unit in Lansing is that we sold it this year.
Yes.
We got it to a point where we had turned most of the units, put in place tenants who met our criteria and were much better tenants. We'd improved the rents, we'd improved the condition of the property, and we were able to sell it at a nice profit, where even though in the first year or 2 we didn't quite meet our projections on cash flow, we more than made up for that in our overall returns.
Yeah, it ended up being, a great property with a great investment. What's really nice about that scenario is that you were able to sell it at a nice profit, but at the same time, the person who inherited it or who bought it had a good cash flowing property that was pulled together.
Yeah.
A lot of the hard work was done for them, and not that they don't have hard work ahead of them, but it ended up being a good situation for your group and for the group that ended up buying it.
Yeah, we had definitely teed it up for success.
Yes.
And it's sometimes you take a property to a certain level, and it's time to let someone else take it over. And that's kind of where we were. And I think at that point, I wanted to kind of pull all of my investments here to Grand Rapids in Wyoming, which brings us to the second deal that we did together.
Yes.
We had done the 71 unit really more as me bringing in the investors, doing a syndication, and you being strictly the property management company.
Right.
Or Green Property Management being the property management company. Then you and I started talking about, well, how can we do some deals together? Let's go after some bigger deals.
Right.
This was around 2014, 2015, and we came across Well, let me just say that the two deals that we've done together have been either off-market deals or in-between market deals. And we came across this 207-unit community in Wyoming, Michigan. And Wyoming, Michigan, for those who don't know, is right next door to Grand Rapids. So it's basically a 5-minute drive from our properties to downtown Grand Rapids, maybe 6 minutes.
4 for some.
If you drive like Marty, 4 minutes. So this 207 units in Wyoming kind of came to us, it had come to us probably about 5 months earlier. It come across our desk because it was part of a larger portfolio that was being sold off. Probably larger than we were able to take on. Because it was a $100 million deal. Yeah. Very well established property management and development company that had built these properties and owned them for probably 30, 40 years was selling off their portfolio here in West Michigan. What happened was a company out of New York ended up buying up this portfolio, but their standards were more, they wanted to be buying B properties in B areas. And there were two of these communities that they considered to be C properties in C areas. They wanted to do what was called peel them off. So they had the entire portfolio under contract, but they wanted to peel off these two particular communities, which were right in Wyoming. And even though they were two separate communities, they were run as one apartment community. So, which meant all the numbers were blended together on the spreadsheet. They wanted a buyer to come in at the last minute who could step into their shoes and basically consummate the deal within 30 days. They had already done all the appraisals, all the third-party reports. They had the loan, a Fannie Mae loan, teed up and ready to go for the entire portfolio. They needed someone with the financial strength to step in and be able to take over that Fannie Mae loan so that they could close within 30 days. So it was a very particular situation that most people would not be able to step into. And that's where we were able to kind of step into that position and were able to buy these properties.
Maybe talk about a little bit why we chose to go to Wyoming. I mean, maybe some of the listeners don't realize where it's located in respect to Grand Rapids.
Yeah, so Wyoming is basically, it's a suburb of Grand Rapids. It's what I consider to be an even better rental community. Wyoming is much more established and affordable. You can get rents anywhere from $500 to $800 for a studio, 1-bedroom or 2-bedroom. B- to C+ type properties, but you're going to have a wider demographic of people who are able to afford living there.
What we have found is that as the downtown market goes to the $1,500 to $2,000 for a 2-bedroom, 1-bedroom, it's pushing some of the people to the outskirts, and it just makes it a ripe market. The good news is that there is so much A product going up in Grand Rapids. Anything that is B in the Grand Rapids area is just like gold.
Yeah,
if you can find it.
And let's talk about the ABC properties. Some people might not know what we mean. So an A property is basically something that was either built, in the past 5 years, or it's brand new. It probably has granite countertops. It probably has stainless steel appliances. In Grand Rapids, a lot of the A property is actually in older buildings that have been completely rehabbed and built out for new apartments. But there are also some new builds going on here as well. So that's the A property, and that's going to command the highest rents. Marty, where you and I typically invest is in the B and C properties.
Yes.
The B property being something that's still nice. Mm-hmm. It's still in good shape. It's relatively new. That could be 20 to 40 years old, but it's in good shape, and maybe it's been rehabbed in the past 10 years, 10, 15
right.
years. You're getting kind of that middle rent range, mm-hmm. where your rents are going to be, maybe $700 for a 1-bedroom to $900 for a 2-bedroom,
right.
or, somewhere in that range.
Mm-hmm.
Now the C properties are older, so these are properties that are built 1970 or earlier. They still can be in great shape, but they're just older.
Right.
That's what this was. These were C properties. We look at them and we say, well, if we can turn these into kind of B communities, then there's upside potential there.
Right.
That's where we saw a lot of potential here. So going back to the deal, we were able to bring in a third investor with us who had the financial strength to step into the shoes on this loan. The shoes of the buyer out of New York. And by the financial strength, let me just explain that. So we were going to buy these two communities, 207 units. The purchase price that we negotiated was $7,650,000.
Right.
That was the purchase price. So to find someone with the financial strength, in this case, we needed someone with personal net worth of at least that amount.
Right.
So, it's not, you can't just go to any investor and find that kind of financial strength. And this is where, Marty, you actually knew someone.
Right. No, and I think that, there's people that I've done business with over the years or friends, and sometimes you have people that can bring the big chunks in and people that can only do small amounts. But in this case, he was looking for an investment. He wanted to do something with what we were doing.
We needed $2 million, basically, as a down payment.
Right.
We were stepping into a Fannie Mae loan, which was, I think, about an 80% loan-to-value loan, 30-year amortization, 4.39% interest rate at the time, with a 10-year balloon.
One of the first ones back in Michigan, I think.
That's right, because Michigan, including West Michigan, had been redlined by Fannie Mae and a lot of lenders, just basically because of the economy and what had been happening in Detroit. A lot of people don't give this credit, but part of what has really made Grand Rapids take off is the fact that in 2014, the Fannie Mae and HUD and all of them basically got rid of that red line, and they said, okay, it's okay to lend in Michigan again.
Right.
So you're right. We were one of the first Fannie Mae loans back in Michigan at that point. And Fannie Mae loan you're going to get some of the best terms on a Fannie Mae loan. You're going to also have a lot of compliance issues, which we doing our best to keep up with.
They didn't understand our management concept, that's for sure.
Yeah, they didn't understand. Yeah, when we had the conversation about green property management and how you operate, it took a little bit of explaining to Fannie Mae because you didn't quite fit in their box.
Right. No.
And that was definitely something that. But the fact that green property management is now a Fannie Mae approved management company is a huge thing because these lenders who lend big money, they want to make sure you have the best management company in place to ensure the health of the property. Let's talk about the structure of the deal because we were able to come in and essentially it was a bridge loan of $2 million that we used as a down payment from our third partner to close on this deal.
It secured the deal for us.
Yeah, because there was no one else who was not only able to come in that quickly with $2 million, be able to step into the shoes on the existing loan. And this is where it was so key that I was partnered with you in Green Property Management. We were able to get in there and do our physical inspection and our due diligence within, I think we were given 15 to 20 days to do it. So we had to move very, very quickly. And this is where it was so key to have a team to walk through the units and look at the mechanicals and really understand how the property works. We were able to do that. Now, we ended up closing more in 60 days. That was more because of the sellers than it was because of us. We were prepared
we
to close
thought
in
we were
30
going to
days.
close in 30 days.
Yeah.
And so we went right at it. And within 2 weeks, I think we had all the full inspections done. We went through very thoroughly with our team and were able to come up with everything that we knew or thought would have to be done going forward. You're right. I mean, that is the benefit of using a company like ours.
So let's talk about the 207 units because when we bought them, I had already been invested in Wyoming. My 37 unit was right down the street, so I knew this area. And I knew how strong the rents could be, or the occupancy, I guess I should say. So our perception going in was that it was really kind of a steady Eddie, strong performing property that would pretty much be turnkey. And it turned out to be just that. I mean, I think that we've pretty much met our projections with our investors. Jason, you're the head of maintenance for Green Property Management, always likes to say, he's got his arms around the property, meaning he's got it under control.
Right.
And I think he was at that point within 6 months.
Yes.
I want to say that when we took over, there were let's talk about the transition.
Yes.
Because that was probably the most difficult part, is you had a team that had been working at the property already. They all knew that the property was being sold. So what tends to happen in those cases?
They tend to not do much anymore after that point. And I would not say that would be the case necessarily with some of the management, but certainly maintenance technicians, if they're on the property, they know that the property is going to be sold. It's not going to matter as much to them if the leaky faucet's fixed right or if things are done right, because it's not they're not going to be held accountable for it probably in the next month or two.
Yeah, they're going to go more into Band-Aid mode and just say, you know what, I'm not going to be here in 2 months. So
right.
So I'm not going to care.
Yeah,
and that's what happened.
Yes.
So that was probably the roughest part of the transition, because when we took over, the day we took over, I want to say there were about 120 maintenance requests.
Yes.
And probably within 30 days, you had gotten that well under 20 maintenance requests. And within 6 months, we were at normal. Typically you're going to have, anytime I look at the maintenance requests, there's going to be 5 to 10 maintenance requests at any given time.
Yep.
Leaky sink, or
it's a property. Everything's going to happen at any given time.
Oh, raccoons in the attic,
which having babies.
That's probably been one of the more complicated things at this property.
Right, and they're back, by the way.
And they're back. Yeah. Thank you. I'll go visit them tomorrow.
Right. It's Christmas time. Every property has its surprises, but for the most part, this has been very steady, and we've been able to increase rents a bit. That's a good sign.
Let me talk about the syndication part for a moment, because that was an important part of the deal. Is we needed to raise about $2,225,000 through syndication. That was in part to pay back our original investor who had put up the $2 million, as well as some other expenses that we needed to pay off. We have a very good SEC lawyer at Warner Norcross and Judd, and we follow the SEC exception 506B, which allows us to bring in accredited investors. For those who don't know what an accredited investor is, it's anyone who has a net worth over $1 million, not including the value of their home, or they make over $200,000 a year in income, or combined with their spouse, they make over $300,000 a year. So we were able to bring in accredited investors, and I think there's probably about 24 individual investors who have invested anywhere from $50,000, which is our minimum, to well over $300,000. And we completed that syndication in 2015. This one, we've pretty much met our projections, and we've got our arms around the property and are pretty confident we'll be able to stay on target with what we've projected for the investors.
It ended up being a great investment for us and our investors, but there's a lot of complication behind the scenes that goes on to reporting and different things like that in making these deals happen. Tell us a little bit about that.
That's the part that I take care of. I mean, Marty and Green Property Management, you guys do the operational management, taking care of the tenants, collecting the rents, doing the maintenance, that kind of thing. My part is the asset management, and that involves both looking at the health of the numbers and the financials and making sure we're on target, and also communicating with the investors. The investors receive quarterly equity distributions. That will be for a certain percentage of the amount that they invested. And what I like to do each quarter is put together an investment report. It's basically me just saying, here's what's going on at the property. And I include photos. I talk with the leasing agent, the property manager, the maintenance team, and you, Marty. And I get all the anecdotal information. The tenants are loving the new lights. The tenants love the smell of the hallways.
Right.
We're having problems with raccoons in the attic. And I put all that in the report so that people are aware of the good and the bad, because there's, you want to share all the good and the bad news. You don't want to hold anything back. So that all goes in the report. And then I also include the financials. So what I'll do is I'll make sure that the trailing 12-month cash flow statement is in there. And that basically breaks down the past 12 months, month by month, all the different line items. Where did the income come from? Where did all the expenses go to? What's the net operating income and the cash flow that's left over each month? I'll also include a current rent roll, so that our investors can see how the property's doing as far as our occupancy. I include a bank statement and a mortgage statement so that they can see that, yes, indeed, we are paying our mortgage, which is required. And they can also see how much money we have in the bank accounts to cover expenses. I think that that's a good amount of information for most investors. And we pretty much have an open book policy. So if investors want more information or they want to see certain reports, we can provide those as well. And Green Property Management uses Appfolio software, which allows us to print up a lot of different types of reports. Let's talk about the third deal we did together. This was an exciting deal, and I think it almost deserves its own episode, but let's kind of just give the broad strokes on it. This was an off-market deal right here in Grand Rapids in Heritage Hill, Oakwood Manor, the tallest building in Heritage Hill, 7 stories tall. Built in 1920, opened in 1923. I mean, it's a historic building, beautiful historic building, reinforced concrete, like 12-inch thick floors, and it was built to be fireproof. And this was an off-market deal that you knew about.
Yeah, how that all played out is several years ago, I actually went after that sort of solo, and it just didn't feel right at the time because of what this person was asking. The market hadn't changed to what it is today. And so I stayed in touch, but I pulled back on that offer. In the meantime, one of our other clients started talking to them about it, put their numbers together, and really was getting ready to close on this deal not that far off. At the last minute, they weren't able to do it. For them, it just didn't feel right to move forward. That sort of left us because we were ramping up to manage the property. So knowing that, I thought, well, maybe we better take a hard look at this ourselves because I think we can do it. That was the minute I got on the phone with you, Brian, and I said, I've got something not even hot. I've got something super hot. Again, it's just a matter of teaming up with the right people. And this one was one that was perfect for us.
It's a beautiful building and a great location. But it was tired, it was undermanaged, and it was not making money.
No.
So the numbers were not good on this. So this was really more of a turnaround project. We identified a lot of ways that we needed to go in and spend money in order to improve this property. But there was good upside potential in the rents. It was being managed in a way that they were getting below market rents. And the perception, both on the management team's part and just the tenant's part, was that it was sort of an old, broken down property, and you're basically paying for what you get.
Yeah. I mean, it was very old school thinking. This is in an area where older homes and older buildings exist. For many years, you only would do what you would have to do to hold a tenant, and you just kept the rents just sort of floating there. Here's this beautiful, huge building that was stuck in the past in that thinking, with all this really cool, new, aggressive approach happening all around them. In my eyes, that was just a beautiful thing.
We saw upside in improving the property, getting the rents up, but we also saw upside in decreasing the energy expenses, because there were first of all the utilities were paid for by the owner. None of the utilities are split, so you're basically paying for the gas. We're paying for the gas, the electric, and the water and sewer. But the gas, you have radiator heat. So you have the hot water for the radiator heat in the winter, plus you have the domestic hot water. Well, they had 2 huge boilers in the basement that were being used for both. Domestic hot water and the heat in the winter. Well, we saw the potential for huge savings there, because if we could install more energy efficient boiler for the domestic hot water and separate that from the heat, well, then for half the year we could turn off those 2 huge boilers. And that would create a huge savings. So, which is exactly what we did. We invested about $55,000 to install an energy efficient boiler and storage tank for the hot water domestic hot water.
Domestic hot water, yeah.
And then it's only maybe 5 or 6 months out of the year that we have to turn on the huge boilers for the radiator heat.
It's huge savings.
Huge savings right there in gas. And we identified a lot of other savings. Now, Marty, you and I are actually going there right after this conversation.
That's right, yeah.
And I'm looking at the time, and we kind of have to get moving. So
Right.
I'm gonna kind of rush through
Yep.
some of the broad strokes of this deal. Lots of great potential. We've really been realizing that over the year and a half that we've owned it. As far as the particulars of this deal, this is another syndication that we did. And the raise on this was about $1.3 million that we needed to bring in. We actually have a bridge loan with the lender, who in this case is insurance money. We went through Greenman Capital, which is a local brokerage here in town, and they brought in insurance money to provide the bridge loan. We're putting a lot of money into the property to improve it, rehab it, and bring it up to our standards. We're also at the same time trying to fill about 6,000 square foot of commercial space in the property. So we're in conversations with restaurant operators who are looking to locate there. In fact, we had a really good conversation last week.
Right.
Well, hopefully that turns out.
Feels like a perfect fit.
Yeah, we can't say much more than that. But just for people who live in Grand Rapids and are wondering what's going on over there, we are trying to get a good restaurant operator in at Oakwood Manor. And then we have room on the other side that could be like a coffee shop or some sort of breakfast place or whatever. So we're working on that. That's an exciting project, and maybe a year from now when things have settled down, we can kind of revisit it and share some of the details. I think we've accomplished what I wanted to do today, which is just kind of talk about how strategic partnerships can really help you grow your portfolio exponentially. And I've been able to do that with you. I was able to do it with other team members and build a 70-unit portfolio. But eventually, no matter what you're doing, you reach a plateau.
Right.
And at that point, you kind of need to reassess and say, what am I not doing, or who do I need to partner with to really kick it into the next gear?
Well, it's been a pleasure.
2013.
It's been a pleasure working as a team and in this partnership with you, Brian. We both have strengths, and the good news is that we use them. And it really has pushed us quickly forward. And it's exciting because together we decide who we want to have in our groups. And we can be kind of picky sometimes, and it's a good thing because we're doing it right.
Yeah, and
you're a big part of that.
Well, thank you, and I feel the same way about you. And we're strategically, adding to our team as well. And so it's not just you and
right,
I. It's,
exactly.
You've got your team, and your team is improving and changing all the time. And then in our deal structure, we're bringing people in too. So I hope everyone listening to this has enjoyed us talk about these 3 deals because they certainly were exciting. And if you're looking to do this yourself, hopefully you've gotten some good information out of our conversation, because it's not a cakewalk. It's not always easy. You will run into problems, no matter how careful you are.
Yes.
But if you have the right people on your team, you can always solve those problems.
I would agree.
Marty, thanks for taking the time to talk with me today.
Oh, you're welcome. Let's go make some money.
Let's go make some money, and we'll do it again. We'll talk about green property management next
Sounds
time.
great.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.